Very good morning, friends. Today's topic will be risk management and position sizing. I've seen many videos that say that position sizing is risk per trade divided by risk per share. That is somewhat true. However, there is some problem with this formula, which I will try to rectify with a simple Excel sheet which I have developed. I will show it to you on screen, and we'll also be talking about risk management in this video. So let's get going. Once again, a very good morning, friends. Today we will be taking the topic risk management and position sizing. So why is risk management so important? Let us suppose that there are two traders, one is X and the other one is Y. X is an aggressive trader and Y is a very conservative trader. So X tends to take 20% of the risk on the capital in every trade, whereas Y takes only 2% risk of the total capital in every trade. So let us see what will happen. Now, if both these traders they adopt the same strategy that has a 50% success rate with a risk to reward ratio of 1:2, what will happen if we go by the worst case scenario by taking 10 trades in which both the traders they lose the first 5 trades? So if the trader X, who is taking 20% risk on every trade he is trading, the first 5 trades, if they fail, trader X, whose initial capital is 1 lakh rupees, will lose the whole amount, that is 1 lakh, in the first 5 trades itself. So he'll be left with nothing after doing first 5 trades. Whereas if trader Y, who is a conservative trader, he initiates trading with a capital of 1 lakh rupees and his first 5 trades they fail, so he'll be at a loss of 10,000 only at the end of first 5 trades, and the last 5 trades if he wins with a risk reward ratio of 1:2, he'll gain 4,000 in every trade. So by the end of 10 trades he will end up earning 10,000 rupees and his capital will rise to 1,10,000 rupees after 10 trades. So this is the difference between an aggressive and a conservative trader, and that highlights why risk management is so very much important. Now the key factors that determine risk management, they are the risk capacity. A young person will have more risk capacity than a 50 years old person who has more responsibilities. Risk tolerance, that is how much risk a person can tolerate. There might be a person who can tolerate a risk of 10,000 rupees in a day, and there can be a person who cannot tolerate even 5,000 rupees in a day. So these are the first two factors which determine the risk management. Then comes the risk to reward ratio. Now this is the total risk on a trade divided by total reward on that trade. In this, the reward should be at least 1.5 times higher than the risk involved. This is the least with which a person should trade with. Then comes the position sizing. People they tell that position sizing is risk per trade divided by the risk per share, and the position size gets calculated by this formula. But there is a glitch which I'll tell you in detail. We'll discuss it. Now this is the calculator. So let us suppose that a person has an initial capital of 1 lakh rupees. Right, this is the initial capital. Now he wants to do 2 trades in one day. So the capital required per trade would be total capital divided by number of trades per day. This comes out to 50,000. Now if we go by the conventional formula of position sizing as risk per trade divided by risk per share, see what will happen. Suppose a particular stock is of 2000 rupees. This is the price of per share, and as per the analysis and strategy which you adopt, the stop loss which comes out is 1990 rupees. So per share stop loss would be price of the share minus the stop loss price, that is rupees 10. This is RPS, risk per share. Now if we talk about risk per trade, the risk management strategy tells us that we should not take more than 2% of risk of the entire capital on a single day. So that comes out to 2000 rupees in a single day on a capital of 1 lakh rupees. In one trade it will be 1000 rupees because we are taking 2 trades per day. Now if we calculate the position sizing with this formula, that risk per trade divided by risk per share will be the position size, it will come out to be 1000 divided by 10, which is equal to 100. Now comes the bitter part, and that bitter part is, do you have the capital to purchase 100 shares? Let us calculate that. One share costs you 2000 rupees. So 100 shares will cost you how much amount of money? 2000 into 100, that is 2 lakhs. But your capital is only 1 lakh. So how will you be able to purchase 100 shares? So that is why I have made this sheet which will tell you how many shares you can safely purchase. So you don't have to do anything on this. Just in B3 cell, give your initial capital, then the number of trades you want to take in a day will come in cell B4, that is 2. The stock price, that was 2000, and the stop loss was 1990. Now if we hit enter, it will automatically calculate and tell you how many shares you have to purchase, what will be the maximum risk involved in this trade, what will be the capital invested for purchasing these many number of shares. So all this thing is taken care of. So the simple formula of risk per trade divided by risk per share, which gives you the position sizing, that is not sufficient, because according to that it was coming out to be 100 shares, whereas we can only purchase 25 shares. In this sheet there are also some other features available, like the stop loss. If it goes beyond 2%, what will happen? Now if we have a stop loss of 1950 on a stock which is trading at 2000, so that will come to 2.5%. So this sheet will automatically tell you that please do not trade in this, because the stop loss is 2.5%, which is more than 2%. This is one thing. Then the next thing is that if you want to increase your per day risk, you just need to change this 2 to 4 or whatever figure you want to change it to as per your requirements. That can also be done. So it will automatically adjust the situation. See, it has automatically taken 4% as the risk. So in cell C6, you can see that it has changed to should not be more than 4% per share. It comes out to 2.5%. Hence you can take this trade. Now again, if you just change this figure to 2%, it will not allow you to trade in this particular stock. So this is the advantage of this sheet. Now, if you want this sheet, that person can simply email me on satishchandra@galileolabs.in and I will share this sheet with that person. Now we will talk about some rules which we need to follow for determining the position size, which we have already seen in that sheet, and the risk management. So these rules, they are applicable only for equity. They are not applicable for futures and options, because in futures and options the position sizing cannot be calculated, because you have to purchase the shares in lot sizes. You cannot purchase 1, 2 or 10 shares. You have to go by the lot size, and lot size can be anything. Like Nifty 50, the lot size is 50, and for Bank Nifty it is 25. For Tata Motors it is 2850. So if you want to purchase shares of Tata Motors in futures and options, you cannot purchase 100 shares. You will have to buy at least 2850 shares, that is one lot, and you can purchase in multiples of 2850 only. So as already told, the risk for the entire day should not be more than 2% of the whole capital. Please bear this in mind and don't ever try to increase this percentage, because that will adversely affect the initial capital which you have invested. Suppose the initial capital is 1 lakh rupees, so 2% of 1 lakh will be 2000 rupees. So 2000 is the maximum risk for the whole day. Now divide your capital by number of stocks to be taken. Let us suppose that you want to take 4 stocks. So do not invest more than 25% in one stock. Now calculate 25% of the initial capital to invest in one trade, which is 25,000 rupees. Now suppose the price of the stock is 100 rupees. So as per the analysis or strategy chosen, the stop loss per share is rupees 2. So risk per share is 2 rupees. And this stop loss should not be more than 2% per share. This is also very important. It should never ever exceed 2%, because then you will be risking your capital. And you can take it, but it is advisable that it should not be greater than 2%. Calculate the risk per trade, which is not more than 2% of the divided capital. We were supposed to take 4 trades in one day as per this sheet. So the risk per trade would come out to 25,000 into 2 divided by 100, which is 500 rupees. So the position size, that is the number of shares to buy, will be 500 divided by 2, which is 250 shares. So buy 250 shares at the rate of 100 per share. Stop loss will be 2 rupees per share. So the total risk is equal to 500 rupees. Now there are some points of caution. First of all, please do not break these rules which are mentioned above. Do not overtrade and maintain your risk limit. If your risk limit is 2000 per day, please maintain it. Don't go beyond that. With the rules mentioned above, if you take 4 trades and 2 or more trades fail, do not trade on the same day. Call it a day off. What I want to say in this sentence is that if 4 trades are taken and 2 trades have failed, so don't try to fight with the system by over trading just to mitigate your losses. Just call it a day off. Take only those trades which fall between the 2% stop loss category, and always place a stop loss. This is the most important thing. Without stop loss, do not ever try to trade. If you are not well, then please do not trade, since the mind will not function as it should and you will not be able to concentrate on the trades. Please don't do it. That's my sincere advice. That was all for today. Thank you so much.